Welcome to Tech Money Matters Weekend Edition, your bite-sized investor education series. Today's topic, moving averages. Simple, exponential, and smarter. And the goal of today's deep dive is to basically demystify this really crucial tool that helps investors, well, cut through all the daily financial noise.
Yeah, there is a lot of noise out there.
It really is. And we're using insights from Investopedia, the CFA Institute, and Wikipedia to kind of break this down. Because let's be real, for you as an investor, looking at raw financial data can feel completely overwhelming. It's literally like staring at static on a screen.
Right, it's just visual chaos. But, while this all sounds like very modern Wall Street tech, the foundation of this concept actually dates all the way back to 1833.
Wait, 1833?
Yeah,
Seriously?
Yeah, 1833. The Bank of England first used it to examine their bullion reserves. They had all these gold shipments coming in, and the daily records were just a mess. So they used this mathematical smoothing technique to find the real trend in their gold vaults.
Wow. Okay, let's unpack this. Because before we even figure out how to calculate a moving average, we kind of need to understand what problem it actually solves for you when you're looking at a chart.
Right. So basically, a moving average is a calculation used to analyze data points. It creates a series of averages from, different selections of a full data set.
Okay, so it's chunking the data.
Exactly. Technically speaking, if we want to get nerdy, it's a type of convolution. It acts as a low-pass finite impulse response filter.
Whoa, okay, convolution, low-pass filter, that's a lot of jargon. Let's translate that.
Fair enough? Yeah.
It's basically like wearing active noise-canceling headphones on an airplane. Right?
Oh, that's a great way to put it.
Yeah, because when you turn them on, it blocks out the really erratic short-term frequency, like the roar of the engines or the daily price jumps in a stock. And it suppresses all that high-frequency noise so you can actually hear the underlying bass track. The moving average is that bass track. It's the long-term trend or cycle.
That is exactly it. And according to Investopedia and the CFA Institute, that smoothing effect is crucial because it helps investors actually determine the direction and the strength of a trend.
Right, because you aren't getting distracted by the turbulence.
Exactly. By reducing that volatility, it makes the data way easier to analyze, which helps you spot potential buy and sell signals without just reacting to random daily panics. What's fascinating here is how taking a step back from that daily chaos actually reveals the true momentum of an asset.
Yeah, taking a step back gives you the real picture. So since we know moving averages act as these, noise-canceling headphones, how do we actually build them?
Well, there are two main types you need to know about. There's the simple moving average and the exponential moving average.
Okay, let's start with simple, the SMA.
Yeah, the SMA. So an SMA is basically just the unweighted mean of the previous K data points.
Unweighted meaning every day matters equally.
Yes, exactly. And K is just the number of periods, like, say, 10 days or 50 days. So you literally just add up the closing prices of those days and divide by K. It's just a rolling window.
Okay, but if you're a computer or even a trader doing this by hand back in the day, adding up 50 or 200 days of prices every single morning sounds awful.
It would be a nightmare. But there's a brilliant mathematical shortcut for this. You don't actually add everything up from scratch every day.
Wait, really?
No. You just take your previous mean, right?
Okay.
And you add the newest data point divided by K, and then you just subtract the oldest data point divided by K.
Oh, wow.
Yeah, it's just a conveyor belt. You pop the oldest day off the back and drop the newest day on the front. The math in the middle stays untouched.
That is so elegant. But here's where it gets really interesting. I'm looking at this and thinking, if the SMA is just this rolling window where every single day is treated exactly the same, doesn't that make it, I don't know, a bit sluggish?
Sluggish in what way?
Well, like, if something huge happens today in the market, it carries the exact same mathematical weight as some random Tuesday from 2 weeks ago, right?
Ah, yes. You've hit on the exact flaw of the SMA. It is completely democratic to a fault. And that's exactly why the exponential moving average, or EMA, was created.
Okay. To fix the lag.
Exactly. The EMA fixes that sluggishness by giving a lot more weight to recent data and less weight to older data. It reacts to what's happening right now.
Okay, so how does it actually do that? Mathematically, I mean.
So the formula is a bit different. You basically multiply the current data point by a smoothing factor.
Which is called alpha, right?
Yes, alpha. So you multiply today's price by alpha, giving it that heavyweight, and then you add it to the previous EMA multiplied by 1 minus alpha.
So it's basically compounding.
Exactly. It creates this long decaying tail where the oldest data barely registers anymore.
Okay, so to summarize this for you listening, if the SMA is basically a democratic vote where every single day gets an equal say, then the EMA is a board meeting where the most recent days are the loudest voices in the room. They dictate the direction.
That is the perfect analogy. The recent days just shout the loudest.
But, because the EMA reacts so fast to recent data, it sounds like a perfect predictive tool, like it's pointing an arrow to where the price is going tomorrow.
And that right there is the single most dangerous assumption an investor can make.
The predictive trap.
Exactly. It's the crystal ball myth. We have to be incredibly clear here. Moving averages absolutely cannot predict future prices.
Right.
They are strictly a tool for analyzing past data. They are lagging indicators.
So what does this all mean for you? It means a moving average is, it's like looking in your car's rearview mirror.
Oh, I like that.
Yeah, it perfectly shows you where you came from, right? It shows the trajectory you're on, but it absolutely will not show you the roadblock 3 miles ahead.
Not at all. You will crash if you're only looking in the rearview mirror. And actually, the CFA Institute brings up another really crucial warning here about trusting this math blindly.
Okay, what's the warning?
It's called the dropout artifact. Moving averages can be disproportionately influenced by old data simply dropping out of the calculation.
Wait, drop it. You mean like the old day falling off the conveyor belt in the SMA?
Yes, exactly. Imagine you have a massive historical price spike in your data window.
Like a freak one-day event.
Right. And your moving average has been artificially pulled up by that spike for, say, 99 days. But on day 100, that massive spike finally drops off the back of a conveyor belt.
Oh, I see where this is going.
Yeah, so even if today's actual price action is completely flat and normal, your smoothed moving average line might suddenly plummet on your chart.
Because it just subtracted a massive number from the formula.
Exactly. It creates a visual trap. A peak might suddenly appear in your smooth line right where there was actually a trough in the raw data, just because an old low dropped off.
That is terrifying. If you're an algorithm or just a retail trader, you might panic sell over a ghost.
Precisely. It's a mathematical ghost.
So given these mathematical blind spots, the lag, the dropout artifacts, how can you safely use moving averages in your own analysis? How do the pros do it?
Well, it all starts with contextual timelines. Your choice of moving average period entirely depends on your specific interest.
Like your time horizon.
Right. Are you tracking short, intermediate, or long-term movements? You use a 10-day for short-term, maybe a 50-day for intermediate, and a 200-day for the macro view.
Okay, so you adjust the lens. But there's a bigger rule here too, right? Like the golden rule of analysis.
Oh, absolutely. The golden rule is that you never, ever use a moving average in isolation.
Right, because of those artifacts we just talked about.
Exactly. Because of the potential for unexpected artifacts and lag, moving averages have to be paired with other fundamental and technical analysis tools if you want to make truly informed decisions. If we connect this to the bigger picture, moving averages aren't the whole story. They are just the lens that brings the story into focus.
They're the compass, but you still need to actually look at the map.
Exactly. You still need the map.
To leave you all with a final thought to ponder here, something that wasn't even covered in the sources, but just kind of logically follows. Millions of traders and computer algorithms around the world are all looking at the exact same simple and exponential moving averages on their screens right now.
Yeah, the exact same line.
Right. So you have to consider whether these lines are just reflecting market psychology or if they're actually creating it by acting as self-fulfilling prophecies. If everyone believes the line means buy, then everyone buys and the line becomes real, just something to mull over.
It's a very real phenomenon.
That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.